Is silver just poor man's gold? Or is it the most undervalued strategic asset of our entire decade? Welcome back to Sandhu Financials. If you have been watching the markets lately, you might feel like something is off. The stock market is at all-time highs, yet people feel poorer. Technology is exploding, yet we are running out of the raw materials needed to build it. We are standing at the edge of a massive shift. 2026 is not just another year on the calendar. It is a perfect storm for precious metals, specifically silver. But why? It is not just because of inflation. It is because of three massive forces colliding at the exact same time. A historic change in leadership at the Federal Reserve, a new critical mineral designation from the US government, and a supply crisis that has been ignored for too long. Today, we are going deep. This isn't a 5-minute summary. We are going to dissect the macro-monetary pivot of 2026. We will look at the geology of the mines, the politics of the central bank, and the geopolitical chess game being played by China. By the end of this video, you will understand why the silver moonshot isn't just a catchy title. It is a mathematical inevitability. My name is Shavez Ahmed. Let's get into it. Let's start at the top of the food chain, the central bank. In May 2026, the term of the current central bank chair officially ends. Now, to the average person, this sounds like boring administrative news. But to the market, this is a seismic event. Think of the Fed chair as the pilot of the world's biggest economic airplane. When a seasoned pilot retires and a new one steps into the cockpit, the passengers, the investors, get nervous. They want to see if the new pilot knows what they are doing. Historically, every new Fed chair faces what we call a credibility test. The markets will test them. They will push boundaries to see if the new chair will break. Here is the trap the new chair faces in 2026. It is a paradox. Scenario A is the hawkish trap. If inflation remains sticky, meaning it stays stubbornly above 2.5%, the new chair cannot afford to look weak. They might keep interest rates higher for longer just to prove they are tough on inflation. Why does this matter for silver? Because silver, like gold, is a non-yielding asset. It doesn't pay you a dividend. It doesn't pay you interest. If you can get 5% risk-free in a bank account, why hold a metal rock? So, high rates are usually a headwind for silver. But then, there is scenario B, the dovish pivot. If the economy starts to crack, if unemployment spikes and we see signs of a hard landing, the political pressure will be immense. Remember, 2026 is an election year. No politician wants a recession during an election. This could force the new chair to aggressively cut rates to save the economy. If they pivot, if they cut rates, that is rocket fuel for silver. But here is the secret that most amateur investors miss. It's not just about the interest rate. It's about liquidity. Think of the economy like a bathtub. The interest rate is the faucet. But there is also a drain. That drain is called quantitative tightening or QT. This is when the central bank shrinks its balance sheet, effectively sucking money out of the system. Even if they cut rates and turn on the faucet, if the drain is still open, the water level won't rise. For a true silver moonshot, we need to see the drain close. We need reliquefaction. When the system is flooded with cash, that cash looks for a home. And historically, its favorite home is precious metals. Now, let's move from the banks to the government. For thousands of years, silver was just money. It was poor man's gold. But in late 2025, something fundamental changed. The US government officially added silver to the critical minerals list. This is a huge deal. It means the government no longer views silver as just a commodity for jewelry or coins. They view it as a strategic industrial requirement. It is now in the same category as lithium, cobalt, and uranium. Why did they do this? Because they realized you cannot build a modern military, you cannot build a green energy grid, and you cannot build advanced electronics without silver. It is the most conductive metal on Earth. Nothing else beats it. Being on this list unlocks new powers. First, supply chain resiliency. This allows for federal subsidies under the Defense Production Act. The government can literally pay mines to produce more silver. Second, we might see the creation of a strategic silver reserve. You know, the US has a strategic petroleum reserve, caves full of oil for emergencies. We haven't had a strategic silver reserve since the 1960s. If the government starts buying silver to fill a stockpile, that is a massive new buyer entering the market that doesn't care about the price. This creates what I call the electrification floor. Here is the difference between gold and silver. Gold is hoarded. Almost all the gold ever mined is still sitting in a vault somewhere. It's recyclable. Silver is consumed. Every time a solar panel is installed on a roof, an ounce of silver is locked away. It is taken off the market for 20 or 25 years. It is effectively gone. In 2026, the demand for solar and electric vehicles is exploding. That industrial demand creates a floor under the price. Silver can't go to zero because industry needs it to function. So, the demand is skyrocketing. The logical question is, why don't we just mine more silver? Welcome to the 80-20 problem. This is the single most important technical point you need to understand. Silver supply is inelastic. Here is the reality. 80% of the global silver supply comes as a byproduct. Primary silver mines, mines that only look for silver, are very rare. Most silver comes from mines that are digging for copper, lead, or zinc. The silver is just a happy accident found in the dirt. Think about what that means. If the price of silver triples tomorrow, going from $30 to $90, can a copper mine produce more silver? No. They are mining for copper. They can't change the geology of the ground. They will only produce as much silver as the copper allows. Now, imagine a scenario in 2026 where the economy slows down, an economic chill. If the economy slows, we need less copper for pipes and less zinc for steel. So, those mines slow down production. And if they slow down copper production, they inadvertently cut the silver supply. Just when investors want silver as a safe haven from a bad economy, the supply of silver drops because the industrial mines are closing. It is a perfect storm for a supply squeeze. I like to use the restaurant pantry analogy. Imagine a restaurant that uses 100 bags of flour a day, but the delivery truck only brings 80. How do they survive? They go to the pantry in the back and use the stored flour. Since 2021, The world has used more silver than it has mined. We have been eating out of the pantry. That pantry, which is the vaults in London and New York, has been depleting for 5 years straight. By 2026, the pantry is running on fumes. There is no buffer left. Any shock to the system will send prices vertical. How do we know if silver is actually cheap right now? We use a macro compass called the gold-silver ratio. This ratio simply asks, how many ounces of silver does it take to buy 1 ounce of gold? Geologically, in the Earth's crust, the ratio is about 15 to 1. Historically, in the financial markets, it averages around 40 or 60 to 1. But lately, in the lead up to 2026, that ratio has been stretched above 80 to 1. Think of this ratio like a rubber band. When you stretch it too far, when silver gets too cheap compared to gold, it eventually snaps back. And it doesn't snap back slowly. Historically, silver plays catch up. It does nothing for years, and then it explodes in a violent sprint to close the gap. If you are an investor in 2026, this is your signal. When the ratio is high, above 80, you accumulate silver. When the ratio drops back down to 50 or 40, you might swap that silver for gold to lock in stability. But we cannot talk about supply without talking about the elephant in the room, China. China is not just a major producer. It is the world's clearinghouse for industrial silver. Even silver mined in South America often goes to China to be smelted and refined. China is currently undergoing its own green revolution. They are installing more solar panels than the rest of the world combined. They need that silver. There is a growing fear that in 2026, if geopolitical tensions rise, China could restrict silver exports. They could say, "We aren't selling this anymore. We need it for our own energy grid." If China moves from being a net exporter to a net importer, the global free float of silver vanishes overnight. The West's reliance on Eastern refining is a massive strategic vulnerability. So, how do you actually play this? You need to understand the difference between the screen price and the physical price. The price you see on the news is the spot price. That is the price of a paper contract on the stock market. But if you walk into a coin shop in 2026 to buy real metal, you will pay a premium. During a crisis, this disconnect gets wild. The screen might say silver is $30, but because there's a shortage of actual bars, dealers might charge $40 or $50. This is the liquidity trap. Physical silver is heavy. It's bulky. If you need to sell $100,000 worth of silver in an emergency, you can't just click a mouse. You have to find a buyer, transport it, and ship it. So here is your strategy framework for 2026. You need to decide which game you are playing. Path 1 is insurance. You are buying silver because you don't trust the banks or the dollar or the digital system. If this is you, the price in 2026 doesn't matter. You don't care if it dips next week. Your metric of success is ounces in hand. You buy when you have the cash and you hold it forever. Path 2 is alpha or profit. You are buying silver to make more dollars. You are a trader. If this is you, you must treat this like a business. You need a buy price and a sell price written down before you start. Don't get emotional. If the gold-silver ratio drops to 50, You sell. You take the profit. We are looking at three potential economic paths for 2026. 1. The soft landing. Silver grinds higher slowly. 2. The hard landing. Everything crashes first. Then silver spikes as the Fed prints money. 3. Sticky inflation. Silver becomes the hedge against the rising cost of living. In all three scenarios, owning a tangible asset with dwindling supply makes sense. 2026 is going to be a volatile year. We have a new Fed chair trying to navigate a minefield. We have a government that finally realizes silver is a critical weapon for the future. And we have a supply chain that is breaking under the pressure of the 80-20 rule. The pantry is empty. The rubber band is stretched. The demand is relentless. This isn't financial advice. This is financial reality. The window to acquire these assets while they are still treated like poor man's gold is closing. Soon, the market will wake up and realize it is a critical industrial asset. You want to be positioned before that happens. I'm Shavez Ahmed, and this is Sandhu Financials. In our next video, we are going to look at the other side of the coin, the stock market. We'll discuss why the S&P 5000 hitting 6000 might actually be a trapdoor waiting to open. You do not want to miss that. If you found value in this deep dive, please hit that like button. It helps the algorithm find more people like us. Subscribe and hit the bell so you don't miss part 2. Stay liquid, stay educated, and I'll see you in the next one.